Hey guys, if your mortgage is coming up for renewal, whether this year or next year, this video is for you. Unfortunately, most people don't realize the options that they've got as they approach their mortgage renewal. Most people will wait to receive the renewal letter. Maybe they'll take a look at some other available rates, but the majority of people will sign their renewal, hope for the best, even if it's not an ideal fit for them. And the thing is, you should treat your renewal as an opportunity. You can either reset your financial game plan, or you can regret the next 3 to 5 years of your mortgage. And if you're honest with yourself, your life has probably changed since you first signed that mortgage term. Rates have changed, the market has changed, and your goals might have as well. So in this video, I'm gonna walk you through 3 things. 1, what's really happening with renewals in Canada right now. 2, what your bank isn't gonna tell you about your renewal. And 3, and most importantly, how you can build a plan for your renewal before the letter shows up. We'll break this down step by step so you can plan and get ahead of all this before it's too late. Real quick, the reason that I wanted to make this video and why I think it's important to homeowners right now is because more than 60% of mortgages are set to renew across Canada over the next 2 years. And that includes thousands of families in British Columbia who locked in mortgages at really low rates during the pandemic, during 2020, with rates like 1.7% or 2.2%. And the thing is, when those mortgages come up for renewal, they're gonna be facing new payment increases of at least a few $100s per month, and in some cases, even more. And the shitty thing is, most of those people won't be ready for the kind of increases to their monthly budget that they're gonna see, which is exactly why getting ahead of this now rather than waiting is gonna make a big difference for you. There is another layer to this that people aren't really thinking about, and it's not just that rates are higher now, it has more to do with the Canadian financial landscape and how quickly that's been shifting. We have household debt at record highs, we have incomes that are not keeping up with the cost of living in this country, and we've got global uncertainty, things like trade, job market, inflation, which naturally is going to put pressure on everything. So naturally, lenders are going to be more cautious. Rules are changing, their appetite for risk has changed, and so those approvals, well, they're not what they used to be. Let's cut the shit and talk about what this actually means for you as a homeowner. Even if rates do drop a little bit this year, lenders aren't suddenly going to just get loose. They're still going to ask for more recent paperwork, more proof, and they're tightening their ratios. So what that means is that mortgage that you qualified for 3 to 5 years ago, well, you might not automatically just qualify for the same one today. And that's exactly why it's so crucial for you to plan ahead rather than just wait for that renewal to show up. All right, let's talk about one of the bigger mistakes people make as they approach their renewal. What you'll receive is an email or a letter from your lender. They'll provide you the new rate. Maybe you'll check 1 or 2 other banks and see if they can beat it. But naturally, a lot of people will just sign it. Rarely ever do people ask questions, push back, or negotiate. Or better yet, put a plan together on how they can use their renewal as an opportunity to restructure things for themselves. And that's exactly how people end up overpaying in a mortgage or getting stuck in a mortgage that just doesn't fit their life anymore. See, the thing is, at renewal, your bank isn't going to be doing a full review. They're not going to take a look at your income. They probably don't know what your goals are, probably don't know your budget, and they won't be looking at your credit at this point. All they're doing is sending you an offer that works for them. And if you blindly accept that offer, well, you're not making a choice for yourself anymore. You're just going along with what works for them. And if you blindly accept that offer, well, you're not making a choice for yourself anymore. You're just going along with what they want. And that is exactly how people get stuck in a mortgage that costs them way more than it should. So if you're open to it, here's what I would do instead. The first thing you're going to want to do is find out exactly when your mortgage renews. Take a look for the maturity date. It's typically going to be found in your original mortgage documents, or you can find it online under your mortgage details. Mark that date down. It'll provide you with a good timeline. But the reason that this date matters so much is because most lenders will allow you to lock in a rate up to 120 days before your renewal date. And as long as the new term doesn't start before the current one ends, you won't be paying any penalties. But it's not just about being able to lock in a new rate, because if you are 6 to 12 months outside of your renewal, well, that's the ideal time for us to review everything for you. We're going to be able to run your numbers, check your debt to income ratios, take a look at your credit, and see what kind of structure is going to make the most sense for you over the next 3 to 5 years. The thing is, the earlier that you start, the more options that you've got. and the more time you'll have to fix anything that might affect your approval. Things like your income changes, credit issues, or high balances. Okay, the next thing that you're gonna wanna do is figure out what your new mortgage payment will look like under current rates. This is the part that can quickly catch people off guard. It can be a nasty surprise, especially if you're not prepared. So if you are coming in off a rate like a 1.8% or a 2.2% from a few years ago, and you're gonna be renewing into a 4.7% or a 5.2%, you could be looking at a monthly increase of anywhere between $300 to $600 a month for the exact same mortgage. The same home, the same balance, you're just paying a higher rate of interest. And all of a sudden, your budget is starting to feel a lot tighter, which is exactly why it's so important to use a proper calculator at this stage, rather than the quick estimate that your bank will send you with your renewal letter. With those estimates, they typically leave out crucial things like amortization resets, your property taxes, and the CMHC premiums. You can use the one that I've got on my website, which is built to reflect more like real numbers as opposed to cherry-picked best case scenarios. It'll take you 5 minutes, but what it will give you is a much better picture or an understanding of where you stand today and give you some breathing room so you can plan ahead properly. Okay, now you know what your payment might look like. Let's take a minute to talk about what the bank is going to ask from you when it is time to renew. At this stage, you'll need to take a step back and take a look at your whole household income, debt, and your monthly budget. You may already know if it has, but it's important to understand if your income has gone up or down since you first signed that mortgage. Also, you need to consider if you added any new debt. Things like a car loan, a line of credit, or you might be carrying some higher credit card balances. Because if you do end up switching lenders for a better rate or some better terms, you still need to requalify. And that means the lender is gonna have to take a look at your full financial picture. They'll wanna look at your income again, your debt load, and your credit score, and whether those numbers still fit their lending guidelines. But even if your mortgage isn't changing, those details will make a big difference in what you qualify for as you approach this stage. This next part is where your strategy really starts to matter. If your monthly payments are about to increase and your cash flow is feeling a lot tighter than you'd like it to be, this might be the time to consider restructuring your mortgage into something that is actually going to fit what you're going through right now. Here are a couple ways that I would look at this. The first thing you could do is re-amortize. You could look at extending your amortization period maybe from 20 years back up to 25 or even 30 years, which will bring your monthly payment down and free up some cash flow. But the thing is here, you will be paying more interest. But that trade-off can really help out your monthly budget, especially right now. This option tends to be best for homeowners who have an immediate need of increasing their monthly payment without increasing debt. The second option that you've got is to refinance, especially if you're carrying some higher interest debt, things like credit cards, lines of credit, or a car loan. You might be able to roll that into your mortgage and pay it off at a much lower rate. What this can do is typically simplify your payments and save you hundreds of dollars in monthly interest, which is exactly how families across Canada are cutting $800 or more off their monthly budget just by rolling in higher interest debt into a lower rate. So the refinance strategy can be a great option if you're feeling stretched across multiple different payments. Third thing you could do is add a HELOC or a home equity line of credit. Here, if you happen to be doing home renovations, or if you have irregular or variable income, or you just want a bit of flexibility, adding a home equity line of credit during your renewal process can give you access to some extra money without touching your main mortgage. This works really well if you want the flexibility without committing to a higher monthly payment. The next thing you could do is switch lenders, because sometimes the best structure or the best lending product or even the best rate isn't provided with your current lender. So if you do qualify, switching lenders can actually help you unlock some better terms with some more flexibility. But this only works if you happen to plan early and give yourself time to explore the different options. The message that I want to get across or emphasize here is that if you're approaching your renewal, you have options, but you only have those options if you give yourself enough time to take a look at them. So don't wait. All right, let's talk about rates and the strategy around rates, because you've probably heard that rates are expected to drop later this year. Maybe they will, maybe they won't. The truth is nobody really knows. So instead of trying to guess what will happen, which we can't control, why don't we focus on something that we can control, like building a plan that actually fits for your life right now? Here's how I would explain it. The first option that you've got is a fixed rate. A fixed rate mortgage is going to lock your rate in for the full term, so your payments won't change. It's stable, it's really easy to budget, and it gives you peace of mind. If rates do drop, you won't benefit unless you happen to break your mortgage, which you're not going to want to do because that is very expensive. Then the second option you have is a variable rate mortgage. With a variable, your rate is going to move up or down depending on the market. It usually can start lower than a fixed, so you might be able to save a bit more money, but your payments or your interest costs can rise if rates happen to go up. The third option is a hybrid mortgage, and this isn't super common, but it will allow you to split your mortgage into two, possibly half fixed, half variable, which can give you the stability, but it can also allow you to benefit if rates drop. But with this option, it can be harder to switch lenders, and it's not always cheaper than just going with a variable rate. Now, the key at this stage is not chasing the lowest rate. It's more so about picking something that fits for your cash flow, for your comfort level, and for your family's game plan over the next 3 to 5 years. I recommend that you focus on what you can control rather than trying to outsmart the market and deal with things that you have no control over. Before we finish up here, I want to list some of the other bigger mistakes that I see when it comes to renewals. The first mistake is waiting too long. If you wait until the last month to act, you've already limited your options. The second one is assuming that your bank's renewal offer is the best that you can get. It's not. The third mistake is ignoring any income or credit changes that have occurred over the last few years since you first signed that mortgage. The fourth one is skipping an opportunity to re-amortize when you need it and you can leverage it to your advantage. And the fifth mistake is chasing the lowest rate instead of building a plan and following a strategy. So if you're not sure where to start, or if you just want a second set of eyes or a second opinion on your numbers, send me a text, send me an email. I'll walk you through a full renewal review. What we'll do is we'll take a look at what your payments could look like under current rates. The second thing we'll do is we'll take a look at your income, credit, and debt that could affect things. And the third thing we'll do is put together a structure that actually makes the most sense and fits for you and your family over the next 3 to 5 years of your term. And if you're not up for a renewal yet, but if you happen to know someone that is, I'd appreciate if you send this their way. It could help them save thousands of dollars or just avoid a painful mistake. Thanks for watching, and I hope to see you guys in the next video.